Good day, fellow investors. The market goes up and down, and here I want to give you a few steps that are crucial to start investing, to think about investing in this environment. This idea was from your comments, of course. Ms. Casimula discussed how if things look too good to be true, you don't want to own it, as Peter Lynch says. And when you're making an investment decision, as Seth Klarman says, you always have to think first about what can go wrong and what is priced in when it comes to investing. And then you can see, okay, if it goes wrong, what happens to me? If it doesn't go wrong, what doesn't happen to me? So let's discuss what is priced in, for example, for the S&P 500. For such valuations, I have this template that discusses valuations, and I also have the S&P 500 here valued on a dividend basis. Guess what? Dividends are for investments. This is the S&P 500 dividend in points. You get that to your account if you own the S&P 500, and I have here assumed 5% growth in dividends. That's the historical growth rate for the next 10 years. Expected return of 10%, a terminal multiple of 50, expecting a 2% dividend yield, and the value for a 2% dividend yield for the S&P 500 now is 2,000 points. This is what is the S&P 500 looking like now. What is priced in? Then you can make a valuation. Okay, let's look at the best case scenario and look at the dividend, and then a 1.5 dividend yield. It's even worse. That's not priced in. So I have to go to, let's say, a terminal multiple of 100. 1% dividend yield is what is priced in now for the S&P 500 at 4,000 points. So 1% dividend. And then you think, am I happy with the 1% dividend if it comes to investing? What can go wrong? Let's go to a historical average. Let's say 4% dividend. 100 divided by 25 is 4. Given the environment, a little bit slower growth, this is what can go wrong with the S&P 500. Of course, everyone will say it's impossible, but sooner or later the impossible happens. So you have to know what can go wrong when it comes to investing and what is priced in, and whether what is priced in, the 1% dividend, is something for you or not. Of course, we are talking about 10% returns here, expected returns from investing. If I change this to 5%, then everything is different, but then you can expect 5% long-term returns on a 2% future long-term dividend expectations. I think the reality is that the dividend will be, let's say, 4%, and then still for 4,000 points, you need a crazy low return. There is no calculation here. The expected returns is 0 for a return there so low. So I can't explain the dangers of investing in the S&P 500. Of course, dollar cost averaging, taking advantage of the lows and the ups, but that's again a strategy, again something you have to know. So this is the recession video we discussed, explaining what can go wrong, dollar cost averaging video explaining what can go right and how to take advantage if you really don't want to think about investment and just protect your capital likely over the long term. Nothing bad with that. So keep in mind always what is priced in and what happens if it doesn't happen what is priced in, and how does it reflect your finances, your life, your decision making, your everything. That's key. So the essence of investing, value investing, is to focus first on what can go wrong. So focus first on what can go wrong. How does that fit me? If it doesn't fit me, hi, goodbye. I personally don't invest in index funds. I look at 25 businesses. One example we just discussed is Cisco. I look at the price, the risk and reward, the cash flows, the likely long-term tailwinds of the sector for the business. Will it make cash? Will it reward shareholders? And then I price it all in a table like this, but it's a premium version of my stock market research platform. This is for free, and then you can see many various differences in valuations. And then you can say, okay, what do I want? The strategy, what can go right, what can go wrong, what is, let's say, good, what is bad, and then you invest around these strategies where anything can happen. That's investing. So just a quick video. First focus on what can go wrong and build your wealth around that idea of the risk of what can go wrong. And if you start thinking like that, which is value investment thinking, then over the long term you will be protected from all the what can go wrong situations, and that alone will push forward your wealth at an amazing pace. That's value investing. It's totally opposite that whatever is on YouTube, but you have to think the opposite way. That's how you accumulate over the long term. Thanks for watching. I'll see you in the next video.